I don't want to even mention the word corruption because we're trying to move into a different psychological and ideological context in Africa. But effectively, the cost of doing business in Africa are very, very high because you've got to consider the political players who are in government at the time. You've got to consider the government's development agenda and whether or not you're a part of that. So think infrastructure drives. Elton's referring to understanding the market and definitely doing business in French-speaking Africa, Portuguese-speaking Africa and English-speaking Africa is going to be varying. How do you mitigate all these elements?
Well, I think you have to deal with them on a pragmatic and fundamental level. So, for example, yes, corruption is a difficult thing to talk about, but there are some nations in Africa where it is prominent, and you must be aware of it and know how to deal with it. When it comes to the various regions, whether it's culturally or language-wise, you need access to resources and people who understand those regions and able to give you advice, whether it's somebody in country you trust or somebody else who's well known for offering advice, or whether it be your lawyers or your bankers. But seek advice, deal with them, get the information up front, and certainly think about it very carefully.
And just in terms of adding to the costs, some of the biggest ICT players, because that's where we've seen a lot of growth, have had to invest in the backbone infrastructure, have had to pay license fees which are in the regions of $20 or so million per country. They've had to deal with varying regulatory environments, and yet they're domiciled in South Africa, which has a completely different approach to some of these issues. Now, it's taken them 10 to 15 years to come of age, but they're beginning to reap the rewards. Do you think that a lot of entrepreneurs or smaller businesses going into Africa have that kind of stamina and budget?
Clearly some do and some don't. I think that the basics are there. The first mover advantage definitely applies. You're moving to an environment that's relatively uncharted. That means it's relatively uncompetitive. And so if you do crack it and you do establish the infrastructure, you are going to do very, very well. However, you may be investing in something that comes to nothing. So as a smaller business going international, going regional into Africa, would I bet the farm on it? No, but there are others that have done so and have done very well, and there are others that haven't. I think you have to look at it on a case-by-case basis, see where the rewards are, and then take the risks that are appropriate for the commensurate rewards.
George, many African economies are dollarized economies, and so effectively that adds another element to the costs of your investment. How do you overcome that, especially when we see foreign currency fluctuations and foreign exchange regimes which are varying on the African continent?
I think that's true, but the advantage of having a dollarized base for most calculations means you have some predictability. So they may cost you more in real terms to do business, or prices may be higher than here in South Africa because of use of a dollar base. You do find you have some predictability, which often is a lot more easy to deal with than the volatile currencies in the country that you're establishing yourself in.
Can we draw a fundamental distinction between investing in Africa and investing in more developed economies, say Western Europe, for instance?
The risk categories, I think, apply globally. I think the accent would be different in certain risk types, but I would say in Africa, the risks that would be different would be access to information, understanding of how things really work there. I think if you look at a lot of business schools and indeed established corporate South Africa, it's modeled very much on a North European / Western business ethos, and so we understand that very well. So ironically, a typical South African business going into North America or into Europe would probably know how things work a little bit better. Africa's somewhat different, and I'm not saying they're not, they're not great opportunities. They most certainly are, but you just need to take more care to understand exactly how things work, and that's where I think the difference would be.
Okay, we understand Western Europe, the United States a little bit better because chances are many of us went to the business schools in the States or the UK, but definitely today's Europe is not yesterday's Europe by any account. It's a recessionary Europe, modest growth in France and Germany, the UK just battling to creep out of that recession. So euro-denominated assets are very expensive. Sterling-denominated assets are very expensive. And the regulatory framework's also varying between the Eurozone, the UK and the United States, managing that terrain.
It's very difficult. I mean, we have an office in London. And I think we've sort of experienced the economic crisis as much as anybody else there. But I've got to say, in Africa, the advantage for the risk taker is the arbitrage. Information is slower to reach the market, so there's a chance to find opportunities and lock them in. But political risk and understanding political risk in Africa is one of the keys. And I think a lot of the foreign players, and to that extent some South Africans, oversimplify political risk in Africa. Some of the comments we hear is the drum always beats the same, but the problem is occasionally the drum changes, not the beat.
The kind of advice that people need in moving into these emerging market economies, especially Africa, but at the same time maintaining standards. You know, as you said, apply the same rules that you would in South Africa as you do out there. The terrain is different. How do you manage to do that?
I think you just have to take a long-term perspective. When the entrepreneur moves into new markets and they want to make, crudely put, a quick buck, a quick killing, that's where standards are going to drop. That's where that's exactly what you're going to get. But if you take a longer-term perspective, you see it as something that requires investment on an ongoing basis, not something to just take your profits out as quickly as possible, then I think that'll do the entrepreneur very well, and I think it'll do the country that you're investing in very well. So my advice would be to evaluate these businesses and treat them and think of them as long-term endeavors and invest in them appropriately.
Building on what Elton says, I think also additionally you need to identify what information you require up front. Dedicate resources to collect that information, study it carefully, and most importantly, once you've made your choice and decision, monitor it and evaluate it so you can change from time to time as risk dictates you need to.
And then building on a competitive edge, we hear that the Chinese have become the largest investors in Africa. The Indians follow hot on the heels of the Chinese. A lot of people moving into the Pan-African space have to be aware of that. How do you build a competitive advantage against the Chinese, who usually import their own labor with good basic skills? They have a lot of money because their economies are heavily subsidized and stimulated, and they're moving into sectors that are quite relevant and that we just can't capitalize on.
I think you have to take advantage of local context, and examples are given of software development, for example, where they'll tell you that per hour it will be a lot cheaper to go to places such as India to get software development done. But you need to qualify that. That's for what kind of software, for what kind of development. There's certain type of work, and to use that as an example, where although per hour it may be cheaper, you're just not going to get the local understanding, the local content and the local context, and therefore you could end up spending a lot more on those countries depending on what you're developing. I use it as an example because I think it applies here. Use the local knowledge that you've got, the local context that we as South Africans have of Africa, to your advantage.
I think working against Chinese interest and Chinese influence is very difficult. We've spent many, many years studying Chinese activities in Africa, and I think you have to draw a differentiation of how you want to compete. Recent exposés of Chinese government entities and businesses bribing African officials for kickbacks on tenders. That's one thing you've got to deal with no matter where you are. But I think in terms of dealing with the Chinese, you've got to understand the market you're playing in, what you want to achieve. In other words, do it in an ethical and sustainable manner. And I don't think China and Africa is sustainable the way it's currently happening.
Right, you've just opened up a can of worms and a whole new debate, but not for this show. Thank you very much, George Nicholls, the CEO of Pasco, Elton Bondi, the founder and CEO of CIS. Thank you for just talking to us about managing risks in Africa, internationally, and also just understanding the fundamentals back home. Well, on that note, we have to end this episode of the Entrepreneurial Edge. Now, if you have any questions on risk management or entrepreneurship in general, you can email SASFIN directly or the CNBC Africa team at the address that appears on your screen. And for more information on this and other CNBC Africa shows, do visit our website, www.cnbcafrica.com. I'm Lerato Mbele. Thank you very much for your time, and goodbye.